Good morning, everybody. Welcome to the Forex Morning Open for October 23rd. It's Friday. And finally, after many long days of boredom, we had huge action yesterday, all thanks to Mario Draghi. Okay, so we'll digest that in detail. And of course, that's the biggest recent development. And also, of course, we'll talk about charts and levels and the next, not 24 hours, but more 12 hours, and of course the next week, which is also very interesting. And as always, I'm looking forward to your questions on the chat room. If you can't see the chat under the video, the address is here below, https tlk.io/fxstreet-forex-live-video. Yeah, looking forward to your question. I've already seen a few people in the room. So welcome Jaxer Wild, welcome Vedran, welcome everybody else that's watching. Okay, so let's see what, well, let the chart talk for itself for a moment. Here we have euro dollar, flat, crash. Okay, so we've seen, well, the euro dollar weakening a bit towards the event. It dropped from 113.40 more or less to 113, then dipped its feet under 113 just as Draghi began talking. And as he continued talking, the drops intensified. It reached all the way to 110.72 earlier today. Now we're at 111.10 more or less. So we did see some kind of stabilization on PMIs. We'll talk about that later. But let's first, of course, talk about what Mario Draghi did. So I have here, well, we should have another point, but first of all, he began the talk with announcing that the ECB is ready to act in December and use all possible instruments. That was understood as not only extending QE beyond 2016, and as I mentioned, that was priced in yesterday, but also changing, he said that explicitly, the composition and the size. So he opened the door to extending QE beyond 60 billion a month, beyond printing more than 60 billion a month. So that's more significant. That's what I said, showing the money thing. Okay, so he went there at the beginning, and then later on in his statement, he also went one step further. I think I mentioned it during the wrap as a remote possibility. And when we have something with low probability that materializes, it has a high impact. So he opened the door to cutting the deposit rate. Okay, and then in previous meetings, Draghi and the ECB said that the current interest rates have reached their lower bound. Well, I guess you can always dig deeper when you're deep in the hole. So we have a negative deposit rate of 0.20. Was set in September 2014. And since then, over a year since then, the ECB always said it has reached the lower bound. But people are still keeping money at the banks. They're not storing it in cash under the mattress. And Switzerland and Denmark already have negative deposit rates. I think also Sweden, and even lower rates, and the banking system still functions. So the ECB is ready to explore even lower levels. Now, this talk by President Draghi was already much more significant because that would discourage banks from keeping money at the ECB, but sending it elsewhere. So that was also even more significant, not only because it was less expected, but because it has a bigger impact. In addition, I wrote here two more points about the narrative. Why are they ready to do more? So they're much more worried about inflation than they were beforehand. However, they were contrary to the Federal Reserve. They don't see now. They changed their mind. They don't see oil as transitory. So yes, they do think that once the base effect will move, that means once we pass November, when OPEC last year decided not to cut production, when oil prices really fell, so year over year we'll have a more normal level, let's call it this way, okay, of inflation. But now they expressed worries that this fall in the price of oil will also impact other types of inflation. Okay, so it already looks worse than expected. In addition, they also, of course, their hidden goal is to weaken the exchange rate, and we saw quite a big impact, a drop of 2%. But this time they said it more explicitly, that they're really worried about the exchange rate. And one point that I didn't put here, let's add it, and number 6 is vigilance. This is a word in English that, well, it's just a word in general, but in this case, it is a bit more significant because this is the word that Draghi's predecessor, Jean-Claude Trichet, the French man, used to use before raising the rates. Okay, each time Trichet said we're ready to act with strong vigilance against inflation, that meant we would have a rate hike next month. In this context, of course, we're talking about a rate cut. So the markets saw the use of this word as a hint that action is coming in any case. As they say here in Spain, sí o sí, yes or yes. So this was also, the use of the language was also a very powerful, very powerful meaning for the euro. Okay, so good morning to everybody. We have lots of movements in markets. That's how what panned out with Draghi. Since then, beforehand and after that, of course, we had other developments as well. But that's, of course, the main event. Let's just look again at the chart just to see the magnitude. Okay, and if we'll zoom out to the hourly chart, you can also see that. You also see on the hourly chart that this move really stands out. So this morning we have some stabilization around 111.11 at the moment, very round. But in comparison to previous days, you can see how these gains that were taken in such a long time were destroyed quite quickly. So 111 is still support despite the break below. 110.70, that's the new low, is further support, and then we have the round number of 110. On the upside, let's put 111.65 here, which was the low last week or 2 weeks ago, as the initial resistance line if we see a nice recovery, and then 112.15, 112.90. How low can the euro go? How far can we fall? That's an open question. I think a lot depends on how we close today. Okay, because also in September, Draghi opened the door to more action. The euro fell. It was seen as a reaction to the rise of the euro in August because of the Chinese crisis. But this move faded after a day, right? So we had sort of 24 hours of euro weakness, and then the euro began rising again. The dollar began weakening again. By the close, it was already sort of business as usual, back to range. This time it seems a bit different because Draghi used all his verbal skills, all the possible tools to hit the euro hard. Negative deposit rate cut mention, which was a remote thing, using the word vigilance, expanding QE, not only extending it, talking also specifically about the December 3rd meeting, everything you want. Now, of course, as I said, he prefers talk over action. I think he's raised the bar very high, so he'll need to act. Of course, the one caveat is two. First of all, if the Eurozone economy is really improving the next 6 weeks, and I don't see that as very likely. Inflation is really too low. China is slowing down. Volkswagen is hitting Germany, you name it. But the real thing that could make a difference is only if the Fed gives us a very thick hint that it's going to hike. In any case, in December, that would, of course, weaken the euro, hit the exchange rate, and then Draghi would have achieved his goal without having to act, okay? So in this case, this is the only case I see the ECB not acting. But I think it's quite a commitment what he made yesterday. What I would watch, talking about what I said around September, is the close today, okay? We're less than 24 hours after the big event. We were now in the European session. We're seeing some stabilization. Then we'll have New York jumping in and setting the tone for the close, the London fix at 3 GMT, and then of course the close of the week. If we see euro dollar ending the week on its knees, on its lows, I would say that's a clear signal that we're going to see more losses in the coming weeks. But if we see some kind of stabilization recovery, it'll show us that the euro is still bid and the battle is still not over. So if we zoom out a bit more, I think we can see that despite this big fall, we're bang in the middle of the high range. Of the post-crash range. So the euro dollar crashed all the way to 104.60 back in March, then climbed all the way to 114.60, and then managed then set a wide range of 108.10 to 114.60 more or less, if we of course exclude this jump in August, which was swing high. So all in all, we're not in low ground. We're in middle ground at the moment. 111.10, bang in the middle. Perhaps if we look at the range only of the last month or so, we're at the lows, but still not with a breakdown. Still around the low levels we've seen in early October, late September. So it's not on the bigger picture. It's not a breakdown. It's just a big fall, a huge fall, but from high levels to the middle of the range. Okay, so let's see if we close below 111, let's say, to sort of give us another clue of where we're going next week. Okay, let's see if we have questions about this topic. No, good morning, everybody. As you know, looking for your questions. So let's, we talked a lot about Draghi, naturally, huge event. Let's see what we have today on our agenda. Okay, sorry, let's begin with what we had yesterday from the United States as well. We had also good figures from the United States that supported also the dollar against the euro, of course, but it's of course not only that story. So yesterday we had jobless claims coming out better than expected. This is the FX rate calendar on Forex Crunch. We have here Thursday. Here we go. We have initial jobless claims coming out at 259,000, above last time, but better than expected. Second week in a row under 260,000. That's, of course, good news for the US economy. Job market remains strong, gives us hope for a strong NFP next month. Let's see the chart. No, we don't have the chart here. Actually, we do. So if you see the jobless claims figure here, and let's enlarge it, that's quite a nice fall, isn't it, from the big financial crisis, and we're seeing the improvement also in recent weeks. Okay, so that was also continued claims improved. Good news from there. Then we had existing home sales in the United States right here, and this came out also better than expected, 5.55 million. It's annualized. It's important to remember that existing home sales, while they form a large part of the market, they're still they don't create the same amount of economic activity as sales of new homes. Nevertheless, it's good news for the US economy. Okay, so these are the two figures, important ones, relatively important, that we had yesterday. They were a bit overshadowed by Draghi, but they're still meaningful. Also yesterday, for those who trading the Canadian dollar, extremely busy week for the loonie. We had the Canadian retail sales came out a bit mixed, left us confused a bit, I would say. Retail sales went up 0.5%, better than expected, but excluding autos, excluding cars, they stayed flat. So we had the Canadian dollar stable. All in all, in markets, we had, let's move back to the hourly chart. We had the ripple effect from Draghi was also felt in pound dollar. Pound dollar we talked about yesterday. Yesterday we had good news from the UK. We had a rise in retail sales that sent us almost to 155. Sorry, just above 155, but it wasn't enough, because then this Draghi effect and the strengthening of the dollar sort of indirectly also strengthened the US dollar against the pound, and we've seen the pound dollar dip below this separator line of 154. We're exactly at this line again. It's important to remember the UK economy is still stronger, and the move by Draghi actually emphasizes the monetary policy divergence, because if we look at euro pound, we're going to see that, of course, the euro weakened much more than the pound. That's why we're seeing this huge crash here also on euro pound. So we've reached support at 72. I think we mentioned this level yesterday as well. We've lost, the pair lost support at 73. So quite a huge move there. Pound remains stronger than the euro. It got a bit carried away in losing to the US dollar yesterday, but I think it's only temporary. Another currency that got carried away is the yen. Yen weakened against the US dollar. The pair went all the way to 121, round level, but still under the high level of 121.20 that we've seen yesterday. It's important, as I mentioned, almost every day, dollar yen really loves the 120 level. So if we've seen it last week drop all the way to 118.10, and we've seen it rise all the way to 121, but slide back to 120. We heard some news from Japan during the night that the government once again said that action from the BOJ is not likely. So we're 7 days away from the important Bank of Japan decision when they have their semi-annual outlook, and currently expectations are very low for action. But who knows? Maybe they prepare low expectations only, to surprise markets later on. Or it's certainly different than Draghi. Expectations were high, and he certainly leapfrogged above it. It was quite amazing yesterday. Anyway, dollar yen is doing some kind of mean reversion, going back to 120. Okay, dollar CAD, we mentioned the retail sales yesterday. So that in general, commodity currencies didn't suffer so much like the euro and then the pound and the yen. They even managed to stabilize. In general, why are commodity currencies rising after Draghi? Because if the ECB says we're going to print more money, print and for a longer time, and cut deposit rates, means they want to send money away from Europe, some of that money goes into risk assets, into stocks, into speculation on commodities, and into commodity currencies. So we've seen dollar CAD sort of grind below the previous levels. Now it's battling this line of 130.70 that was resistance in the middle of just last week actually, and let's see if we have a break below this level back to 130. A lot depends on some figures we have from Canada later on. We'll cover that as well. Okay, let's talk about that actually. Later today we have Canadian CPI. Core CPI is of course more important for the Bank of Canada. So expectations here stand on yearly figures are more important. Headline CPI is expected to drop from 1.3 to 1.1 related to oil prices, but core inflation is expected to stay at 2.1. So these are the figures to watch for Canada. It could determine the close. If we have good figures, dollar CAD could slide all the way back to 130 and even lower to the levels seen last week. 128.25 is, of course, the most important support line. 129 was a mini double bottom. Battle line remains 130.70. If we have bad figures, I would say 131.60 is resistance, the high we've seen this week, and then 132.20. Also, the New Zealand dollar managed to bounce from the lows. Could call that maybe an inverse head and shoulders. I'm not sure. Anyway, we've seen it reach 67. Yeah, twice. So we could call that maybe a double bottom, a small one. But from there, it managed to break back above 67.40, which was resistance last week, and all the way to 68.34 at pixel time, as they say. 69 is critical resistance for the Kiwi dollar. Aussie dollar also managed to recover. So we've seen it make a very nice break below this wedge, below the triangle earlier this week, went all the way below 72, and now it's recovering to the same 72.80 line, which was the post-Fed high and remains the battle line. Wider levels to watch there are 72 and 74. Also, the Australian dollar enjoys this risk-on environment, higher stocks, higher bonds, and more risk thanks to the ECB basically taking the baton from the Federal Reserve. The Federal Reserve used to be the big money printer. Okay, let's talk about dollar Swiss. I suspect, okay, we've seen a stronger dollar, of course, on what happened. We've seen a stronger dollar against the pound and the yen, not only against the euro. That's why we've seen this pair jump high. 97.30 is the current level. It's already 250 pips above the lows seen last week at 94.80. 98.50 is resistance. Currently, the pair is stuck at these levels. 97.50, I would say this is a line of resistance. But I believe we've also seen some intervention from the Swiss National Bank, because when the euro weakens too much, we've seen they try to intervene to mitigate the effect, to smooth, not allow euro Swiss to fall too much. They want a weaker Swiss franc. Well, everybody wants a weaker currency. So we've seen it relatively stable in comparison to what happened elsewhere. We've seen it at 108.20. We've seen it maybe this line of 107.80 is the line that the Swiss National Bank defends. We've seen now 108.20, and well, previous support line was 108.70. Now it's resistance, and 110 is high resistance. So watch out for this 107.80 line. Perhaps this is where the Swiss National Bank intervenes. Anyway, they are watching Draghi very closely, if not vigilantly. Okay, let's see if we have some questions. Yes, we do. Good morning, everybody. Good morning, Pan. Good morning, Sirik. Very interesting indeed. Yes, I agree. A question from Vedran. Euro pound broke 72.20. Next target is 72.60. So I understand you do see euro pound recovering, right? Let's take a look here. Well, we do see it stabilized at 72, which is a support. Yeah, the low has been even very round, 72. Oh, it doesn't always happen this way. Resistance. I don't see much resistance until 73, because that was the bottom that we had earlier in the week. But maybe let's zoom out and look for more levels. Maybe I see 72.60 like you. No, not exactly. The line, I think, as far as I see it, yeah, we did have a low of 72.60 here. Maybe perhaps it's very minor resistance. Yeah, I wouldn't want to rule that out right here. The line that I've just placed, 72.65, because that was a low seen last week, 2 weeks ago actually. But I would say that more significant resistance is 73. 72 now turns into a double bottom and is very strong support. In case the euro continues falling into the close of the week, this is a level to watch out for. Yeah, 72 to 74 is the wider range, very similar to Aussie dollar. Okay, let's see more questions. Question from Pan: do you think that pound dollar is in a new range, or is there a reason it may fall further? I guess line in the sand is 153.70. I think that it's just a small the pound dollar, that cable just got a bit carried away. Maybe 153.70 is an extension. Perhaps the range has widened just a bit. I don't see the pound dollar as collapsing. The UK economy is doing well. We're going to have GDP figures from the UK to remind us of that next week. The Bank of England is expected to raise rates after the Fed. So I think a few major pairs got carried away. One of them was the pound, but we're seeing it creep back up into the range. No figures from the UK today. I see the pound is relatively stable. Neutral to bullish, I would say. I wouldn't say it's on the way down. So perhaps an extension of the range. If we let's put a line here on the low, okay, and see. Wait. And see if we have a more interesting move to the downside. If it broke below some kind of Just a second. Let's put it here at 153.70 that you mentioned. Yeah. And let's zoom out a bit. Yeah, that was sort of the high seen beforehand. So maybe it's an extension of the range, and not more than that. I wouldn't say it's a breakdown. Okay. You're welcome, veteran. 153.65 longer term support. Yeah, could be because that was the resistance line last week. But I'm more looking at the round levels of 154 and 155 in pound dollar for the range. And we would need a disaster from the UK to see the pair fall. All in all, the monetary policy in the sort of division of monetary policy divergence, the pound is on the tightening side together with the US dollar. Then the other side, we have Japan and the Eurozone, if we look at the biggest economies. Okay, let's look at what else we have today on our agenda. We have from the United States, markets flash manufacturing PMI, give us an indication about the US manufacturing sector that has been quite weak. It's not the important ISM manufacturing PMI that we have in the United States. So it's just a sort of a warm-up. It's not insignificant, but not as important as the ISM number that we'll have only at the beginning of November. So we're expecting here in markets number, a small drop from 53.1 to 52.8. Jumped over what we had earlier this morning. We had better than expected figures from the Eurozone. They didn't help the euro too much, but at least in France, we're seeing a bit sort of still growth in manufacturing and ongoing growth in services. Both numbers came out better than expected. In Germany, we did see a big jump in services, which is good news, to 55.2, and the more or less expected slide in manufacturing to 51.6. I would say that these numbers show that German manufacturing sector is still relatively resilient. Perhaps they're not afraid that the Volkswagen crisis is that bad. But we have on Monday the IFO number from Germany, a very important survey, and that could tell us more about how the economy is doing there. Let's see if you have more questions, and I'll talk about what expected next week. Marcy asks, can we have a risk on of easy explanation? Yeah, I think, well, when we're when there's a risk on environment, it means that markets are happy, people buy stocks, they buy more riskier assets. That means buy commodities, commodity currencies, stocks, you name it. So when we have a risk on environment, we see the Australian dollar, New Zealand dollar, Canadian dollar rise, and together with stocks and safe haven currencies such as the yen weaken. Okay, the yen is the classical safe haven. When we have risk off, we see strengthening of safe haven currencies. That means, first of all, the yen, and then sort of second or third tier, we have the US dollar, the euro, and the Swiss franc. The yen is clearly a safe haven. The others are not always behaving that way. Okay, but in general, if you see stocks falling, you see the yen rising. Okay, that's sort of the general risk-off environment, and you see commodity currencies falling. We've seen it very strongly in August when we had the Chinese stock market crash. We've seen the yen strengthening very rapidly, the euro strengthening as a safe haven currency, and all the commodity currencies, the Aussie, the Kiwi, and CAD, collapsing. Okay, so that was a clear risk-off environment. Now, thanks to Mario Draghi, we now have risk-on environment. That means commodity currencies are improving, and against the US dollar, and dollar yen are more or less stable as the currency pair, and the euro is weakening as safe haven. Okay, so that's sort of a quick explanation. You can search. Actually, there's a presentation that's going to be up on the site on Forex Crunch, and you can see a presentation I gave for FX Street earlier this month, a recording of that video, and a significant portion of that presentation is dedicated to risk on, risk off. So I suggest watching that. Okay, so let's look back here at events for today. A small note, we're going to have a change in daylight saving times here in Europe, but not in the US. That means that publication times are going to be a bit different next week. But of course, you have all of that on your calendars. Next week, we have on Monday German IFO to talk about Volkswagen, of course, and that's what I'm looking for. US new home sales, which, as I said, trigger more economic activity than existing home sales. Then on Tuesday, we have GDP from the UK. It should be very interesting to see if the UK economy continues growing. Durable goods orders from the United States. The Fed looks at that to understand what's going on in long-term investment, especially core durable goods orders. Consumer confidence, which is theoretically correlated with retail sales. Wednesday is a much more important day, starting with the Australian CPI, and then the Fed decision. Fed decision, this is of course always important because it has a huge impact on all markets. This time there's no press conference, no forecasts. The Fed is expected to leave rates unchanged and hopefully give us some hints for December, but the Fed likes to remain opaque, so I'm not sure we'll have real data. It doesn't mean you won't have movements. I believe we'll have lots of action. Then we have a decision by the Reserve Bank of New Zealand. Let's see if they cut the rates once again or delay it for 1 month. And on Thursday, very important, US GDP, the first release for the third quarter after a rise of 3.9% annualized in Q2. We're expecting much, much slower growth in Q3. I would say about the Fed decision on Wednesday that the Fed will already have the GDP numbers in front of its eyes. We will not have them. So we might get a hint from the Fed. If the Fed is more optimistic, it could imply better GDP. And if the Fed is more pessimistic, negative GDP. So in any case, it's only the first release, and then there are huge revisions. And on Friday, big day for Japan, Japanese inflation, the rate decision in Japan. Currently, we're not expecting any move, and that could strengthen the yen. But who knows? The Bank of Japan did surprise us in the past more than once. We also have Eurozone CPI to see how bad inflation really is. It's the preliminary release for October, and Canadian GDP. So we have sort of less figures from Canada after a very busy week this week, and then we'll see what's going on. Okay, another question from MRC on risk off. USD dollar CHF doing what? Sorry, I didn't catch it. Well, when we have risk off, that means the yen strengthens because the yen is a safe haven currency. Usually also the dollar and the euro strengthen. The Swiss franc is also, Swiss banks are considered safe, but because the Swiss National Bank is intervening, it's no longer a safe haven currency. So on risk off, it's first of all yen strengthening, and also usually the euro and the dollar. But the big differentiation is between the yen on one side and commodity currencies on the other side. Risk off, stronger yen, weaker commodity currencies. Risk on, weaker yen, stronger commodity currencies. Okay, so that's another explanation for you. Let's see what else we have here on the agenda. Okay, quite a busy week next week, especially towards the end. It's the last week of the month with the last week of the first quarter. We have in the US this, of course, double feature of GDP and rate decision. Okay, let's talk about more currency pairs, and we have a bit more time for your questions before we move on to the wrap. So euro yen clearly showing we fell all the way to support at 133.15. Yeah, a bit above that, sorry, 133.50. Actually, it's been the level in early October, but still not the lows of late September. Quite a big fall. Of course, druggy related, 137 is the big level above 135.60 is not as strong as it used to be. And let's see, 134.20 already serves as resistance. It used to work as support in the past. Pound yen, one of your favorites. So we have reached 186, even went to 186.17. So far it's a false break. Why did I talk so many times about 186? Because when the pair traded on a high range in mid-September, you can see the support line of this range was 186. It traded in the range between 186 and 188.10, and 186 is resistance. So far, the weakening of the yen and the relative stability of the pound sent it higher. I think the jury is still out on that. It's not a break, it's not confirmed, but anyway, an interesting move from the middle of in the past week or so. We're seeing pound yen rise gradually, a bit choppy. I would say it's not the classic rise, small correction and then another rise, but a bit more choppy. But I guess some of you prefer to see many pips and more excitement. So that's the way it goes with this currency pair. Let's see if I have here something else for you. No, let's look back at euro dollar. Once again, we're seeing some kind of recovery. Well, 0.12% higher on the day. In terms of pips, well, of course, we're off the lows, 111.20. Still 200 pips below, or even more below yesterday's levels, but a bit of recovery. Most important thing to watch here is the close. I would say if it falls below 111, it would be a bearish sign, more or less. Dollar yen mean reversion. Pan says, yes, bang on target for profit taking regarding pound yen. And Mercy says, thanks a lot. Oh, I missed here a question from Vedran. Asks, and what are you thinking about the Fed? Raise rates or not? I still think they'll raise rates because they want to fight a bubble and they expect inflation to eventually rise. But if we look at the recent figures from the United States, two bad jobs reports, and of course the mandate of the Fed is full employment, and if inflation does not make signs it's going up and employment is sort of going down, not falling, but rising at a slower pace, it's of course very worrying. We have two more NFP reports until the December decision. Currently, markets are not expecting a rate hike in December. Economists do, bond markets no. So let's look here at this is a very useful tool from the CME group. It's called Countdown to the FOMC, 5 days to go. So for October, of course, 95% expect implied probability of no rate hike because no press conference and not enough new information. In December, 68% against, okay, very low probability of a move according to bond markets. This may change, of course, if we have better data. In January, no press conference, 59%. Only in March, markets expect the Fed to raise rates. We have a press conference there. I still see the chances of a rate hike. We've received mixed messages from the Fed. They've been, of course, more dovish after last week's poor retail sales report. I suggest we wait for the NFPs, of course. Next week, we also have the core PCE price index, the Fed's favorite inflation number. And let's see how that goes as well. Of course, next week, we aren't expecting anything. We're expecting to see a repeat of September in terms of the statement and nothing more. Okay. You're welcome. Yeah, okay. So I guess it's time for wrapping up the show for today and for the week. Again, from the beginning, this is the wrap of the live market open for Friday, October 23rd. We had lots of action thanks to Mario Draghi, the president of the ECB. He not only opened the door for extending QE to September 2016, but also for printing more money than 60 billion a month that is currently going. Even more significantly for the euro, he opened the door to cutting the deposit rate, changing the policy of the ECB that said rates have reached their lower bound. So these expectations for the future, of course, make things bad for the euro. He also used the word vigilance. Okay, so the ECB did not act yesterday, but they did. Draghi did hint about more action, and more importantly, used the word vigilance, which in the past used to mean imminent action. Bearing any disaster will have a significant move from the ECB on December 3rd, and that's why the euro collapsed. And the reasoning for this is that they're worried about inflation and they're worried that oil will reach other sectors in terms of falling prices, and that the exchange rate, they said it out loud, it really worries them. So euro dollar, of course, a huge fall here on the charts. We had it, well, that's a crash, 2%, which is huge in currency markets, falling all the way from above 113 to the lows of 110.70, now stabilizing. Most important thing to watch is the close. If we have some kind of recovery like we had in September, that'll mean we're still in range, perhaps even going higher. Perhaps the market is going to fade this move, think, well, the Fed isn't going to move either, okay? But this time could be different because Draghi shut all his verbal tools, and perhaps this time I would watch the close of 111. If we have a close under that level, if we have the pair closing at the lows and not recovering too much, it would imply for me more falls in euro dollar. Elsewhere, we had good figures from the US, better than expected. Jobless claims, better than expected existing home sales that helped the dollar. We had other currency pairs such as pound dollar and dollar yen getting a bit carried away and now getting back to normal. So pound dollar dropped a bit under support 154, but stopped at 153.70. Currently grinding back into range. Dollar yen went all the way up to 121 and now back towards the level that it really loves and hugs, 120. Commodity currencies did gain from the move because more money printing, doesn't matter if it comes from Europe or the US, is good for commodities and commodity prices. And for stocks, of course, we've seen rallies. So dollar CAD is improving, reversing the losses seen after the Bank of Canada cut growth forecasts. Kiwi also inverse head and shoulders, currently 68.80. The wide range is 69 to 67. Okay, Aussie dollar, which already dropped below 72, is now back to the battleground of 72.80. And dollar Swiss, of course, it raged higher. I think that the Swiss National Bank is intervening to keep the Swiss franc in line with the euro. That means a weaker Swiss franc. Okay, so today we're expecting look out for the close, and there's also Canadian CPI that impacts the Canadian dollar. Core CPI is of course more important, and US flash manufacturing PMI, and of course echoes from Mario Draghi. That's it. We'll be here. That's for the show for today. We'll be here, of course, on Monday morning with a fresh, with a busy week as well. Yeah, let's see if we have last questions for the week. Yeah, good. How do I get a recording of the show? Well, on YouTube, there's the FX Street channel. All these things are recorded as well. They're republished on FX Street, republished on Forex Crunch, and available on the YouTube channel. And you're welcome. You can see. We'll have also later on a separate recording of the wrap up, not only the full show. So all the data is, of course, available for you guys. And yeah, so thanks everybody. Thank you for your questions. I hope we get more action like yesterday, more days like yesterday, and less days like the days that we were beforehand. And see you next week. Have happy trading and great weekend.